Hello, I'm Paul Pfeiffer. I'm the Chief Financial Officer of Anderson Trucking Service, and I'm back. This time, we're here to talk about the truckload transportation industry as we head into 2024. First, let's put a quick bow on 2023. While the U.S. economy may have avoided being in a recession in 2023, transportation industry did not. We have been, and still are, in a freight recession. It's brought on and complicated by three particular factors. First is that macroeconomic shift of consumer spending in the U.S. away from goods and back towards services, which is more normal, coupled with an inventory correction cycle, has brought the freight volumes way down. The second item is that the resulting lower demand of freight caused an oversupply of capacity in trucks to be able to move that lower freight demand. And while both of those things were going on, inflation was driving up the cost of operating a trucking company in a significant way. All three of these things are going to be things that continue to linger on as we enter into 2024. So let's transition over to 2024. Overall, my expectation in the transportation industry this year is going to be in another year of transition, where supply and demand come back into equilibrium. How's that going to happen? Well, first, let's take a look at the backdrop of the macroeconomic environment that we see. In 2024, let's start with the consumer side. So you have the consumer, and the spend there makes up about 2/3 of the GDP in the United States. Well, job creation is still at decent levels, as measured by the non-farm payroll ads. That's keeping the unemployment rate low in the U.S. and pretty stable, hovering around that 3.5% mark. The housing market, still pretty strong. It's down from its peak, but still at really healthy levels. But, and this is a big deal in my mind, that most of the purchases that are happening right now are on credit. And with the rise in interest rates, in order to be able to control inflation, that debt is a lot more expensive than what it was a year ago or 2 years ago. And I think that's going to have a big impact as we head into 2024. Now, if that's the consumer side, on the industrial side, that roughly drives the other third of the GDP in the US, not as pretty as a picture. Manufacturing, still sluggish. For all of 2023 and for the start of 2024, the PMI manufacturing index is below 50. When you're at a score below 50, that's a level of contraction. When it's above 50, it's a level of expansion and growth. So we're not growing there, and you've got that incredibly high cost from inflation that's squeezing corporate profits. As that happens, business fixed investment starts to decrease, and that's what we've seen. 3 successive quarters of business fixed investment reduction. There's a lot of different things going on. You hear a lot of different things in the news, some good, some bad, some you don't know what to think about. Well, when that happens, I tend to pull back and look at the basics. And to me, the basics are, if the consumer drives 2/3 of our economy, and they're in a spot where they're spending on credit and the cost of that credit is higher, those 2023 bills are going to come due in 2024. And I don't think I can paint a picture of how that doesn't impact the economy negatively in 2024. My base case is still that we are going to be in a recessionary period in 2024, probably the middle part of the year. Let's see what happens. So, how does all of this macroeconomic picture impact the transportation environment? Well, again, back to the basics for me. The 4 things that I generally look at: demand, supply, cost, and then rates. If you start first on the demand side, if my base case is that there's going to be a recession in the mid part of 2024, then my expectations are that freight demand is going to be pretty low for most of the year, if not all of the year. And when you peel back the covers a little bit, 2 of the segments that truckload serves, one is the open deck area, another is dry van freight. It's because the segments that they serve, like construction, are very sensitive to higher interest rates. So I do see a little bit of weakening on the open deck side. Is it possible that the infrastructure spending from the government bills passed a couple of years ago starts to help balance that out? Potentially. So if that's the demand side, second is the supply side. The key thing to know on the supply side is that for 18 months, we have been living in a situation where we've had more supply of drivers and trucks than the depressed amount of freight that is out there to move. If you look back over the last 20 to 30 years in the freight recessions that we've been through, typically that cycle will last for 9 months, maybe 12, but certainly not 18. And there's not a really good measure of capacity and how quickly it gets added or comes out in our industry. And so again, I kind of look back at history to be a predictor of the future. And when I do that, capacity usually exits in 2 stages. The first is as spot rates come, down significantly, like they had, then the first step is those individual drivers or smaller trucking companies generally head to the fleets to start looking for a reliable pipeline of freight. When they get there, if they find that the freight's not there, then the second step is, or the second stage is, those drivers exit the market. We're at that second stage. Capacity has come out fairly slowly through 2023, but in 2024, especially the first 2 quarters, I think we're going to start to see that capacity exit start to pick up. And why? Well, it's because we're dealing with the same 3 things that we did in 2023. First is that depressed level of freight. Second is depressed rates. And third is costs are continuing to rise, which brings me to the third category of costs. We all know what the big cost drivers are in the industry. Well, the theme in 2024 is that costs are going to continue to go up. Is it going to be at the same pace as it was the last 2 years? Maybe not, but still definite upward pressure. Insurance, easily going up at rates faster than inflation. Equipment and maintenance. If you look at the OEMs and the shop networks throughout the US, what have they been dealing with? Higher labor costs and higher parts costs. So that's going to push that up. Which, what does that do? That squeezes the most important part of our industry, the backbone of our industry, which is the driver. Because you got low rates and rising costs. They've got to make a decision. Either they can't haul the freight at those rates and they've got to look for other options, or they exit the industry. So that brings me to the last and the fourth category of rates. Now in 2023, the spot market did bottom out and even inched up just slightly. What's my expectation for 2024? Well, in 2024, I expect that shippers are going to be very active in the pricing and bid season, and they're going to be looking for one of 2, if not both, items. One is another round of rate reductions if they can get them, and 2, maybe holding some of those lower rates in for a longer period of time. That activity is going to be really active in the January to April, January to May type time frame. The challenge is going to be as those drivers and individual trucks are dealing with that increasing cost, they might not be able to move that freight at the rates that they were awarded at. And that's going to be the challenge in order to be able to get that freight moved. My expectation is that enough capacity is going to come out in the first part of the year that we'll start to see a shift of volume over into the spot market or back to the spot market, and those prices start to go up a little bit more, but that's not going to be until the second half of the year. So my final takeaway, I guess it doesn't matter where you are in the transportation world, you want to be looking for those stable companies that have the assets to be able to meet the service needs that you have. I know this is high level, oversimplified, but hopefully it's helpful. Have a great and safe 2024. Thank you.